Hi, everyone. My name is Mark Henry, and I'm one of the practice leaders of Citrin Cooperman's manufacturing and distribution practice. We're here today to explore the possibility of adopting LIFO given today's unique inflationary environment. We're joined by Jennifer Flynn and Brian Coddington of Source Advisors, who will help walk us through potential strategies and examples of the tax benefits of adopting LIFO. We're also joined by Will Fernandez of Citrin Cooperman, who can share some real-life client examples that he has had helping clients implement LIFO and on the financial and the tax side. Jennifer?
Hi, everyone. My name is Jennifer Flynn with Source Advisors. I'm the Northeast Director of Client Service. And just to give you a quick background on Source, we started our business 39 years ago, and we only did LIFO until the early 2000s. So we are experts in this space. We also now offer R&D tax credits, cost segregation, 179D, 45L, and the employee retention credit. I want to remind you guys about LIFO and let you know that it's an oldie and a goodie. Companies are bearing the burden of price increases, which are often not fully passed on to their customers, and then they need to pay income tax on those price increases. It's really unfair. So LIFO removes inflation from year-end inventory, which then reduces taxable income. It's an interest-free loan from the government that eases the pain almost every industry is experiencing right now. Today's featured speaker is my colleague, Brian Coddington. Brian is the Director of Tax at Source Advisors. He's going to provide a short overview of LIFO, and please feel free to answer questions into the Q&A section of Zoom. And Mark is going to run the Q&A session at the end of the presentation, so please hang on and listen for your answers. Thank you so much for joining us today, and hopefully we'll enlighten you.
Thank you, Jen. So today I'm going to go over the basics of LIFO. And this isn't even going to be a deep dive into LIFO, just a very high-level overview. So what is LIFO? Now, we can say that's an accounting methodology that allows you to reduce your taxable income by the inflation that is in your year-ending inventory. It's also an annual calculation that results in an accounting entry. If you're curious, it's usually treated as a contra asset account on your balance sheet for inventory. And you make that adjustment once a year, or if you want to, quarterly or monthly. And finally, it can also be different for book and tax. Now, technically, it's a cost flow assumption. You assume that older, less expensive inventory remains on hand and that you're getting rid of the last in inventory, that the last in inventory is the first out the door in sales. And what this does is it removes the negative effect of inflation on inventory costs. Under the typical FIFO method, there might be phantom profits when there are inflationary prices for a business. And we tend to think of it as an indefinite income deferral or interest-free loan from the government for using LIFO. Now, why LIFO? Why now? Well, the biggest news is, probably not news to anyone, is that inflation is back. And we've said this many times over our careers. I've been doing this for 20 years, and every few years, inflation is back. Well, that usually means for one sector of the economy that inflation is here and it looks hot. Well, we're seeing stuff we haven't seen in over 40 years now. Inflation, we thought would beat an inflation as a widespread phenomenon years ago, back in the 90s or early 2000s. Well, apparently we didn't. It's back. And because of inventory is one of the largest assets, if not the largest asset on a balance sheet, then it is worth it to look at it from that perspective. That we're going to look at, this is your biggest asset. What can we do with it to help you save taxes? And despite the fact that there's been a great deal of tax reform, both actual and in discussion over the last 5 years, LIFO repeal, that threat, is largely gone. There's been some discussion of perhaps oil companies, due to their record profits, perhaps recognizing limited benefits from LIFO or not being able to use it, but there's been no industry-wide discussion of getting rid of LIFO. So that's great. And finally, it is a very common and IRS accepted, that's the key point, accounting method for businesses. It's an annual adjustment. It's not going to impact your day-to-day, and it requires a minimal investment in time. That's why we always like to say LIFO means leave it for others. Well, I'm part of that others, so I'm going to explain a little bit more about what LIFO does. And, normally, this is where, when I'm presenting to a CPA audience, I do a deep dive into the details of what LIFO is. And I start out saying, oh, well, we're going to go back to intermediate accounting, which may be the only time you've ever seen as an accountant a deep dive into LIFO. Well, we're not going to do that today. Today, we're just going to look at a very high level example. And in both examples, both with and without LIFO, you have $35 million in top line revenue. But on the LIFO method, your cost of goods sold are going to be increased by $600,000. That $600,000 is what we call the LIFO reserve. Or because this is a first year example, most years would call that the LIFO expense, but this year it's the entire LIFO reserve. And so that is an increase. That's the difference between FIFO and LIFO for this year. So $600,000, which by today's standards isn't even all that great, but it's an old example. Operating costs, those are going to stay constant, but because you have $600,000 more in cost of goods sold, your taxable income drops. So your income taxes drop. And so you end up with about $210,000 in extra cash flow, which this is why companies use LIFO. In an inflationary economy, when prices are rising, it will strip out the phantom profits due to inflation and allow you to keep more of your cash. Now, who's a good candidate for LIFO? That's always a wonderful question. And if a company is already using LIFO, well, they're a good candidate for being on LIFO because there may be a LIFO method in place, but it may be hard to use. It may be cumbersome. It may require a lot of staff hours and internal time, or it may require a lot of time for your CPA firm to use. A lot of billable hours there. And it can be examined. Can it be optimized? Can it be improved? Can the time be minimized? And also, if a company isn't using LIFO, and if they're profitable, if they appear to have inflation in their industry, and that could be either their own internal inflation or based on government indexes, and if they carry an inventory of at least $3 million year in, year out. Now, that $3 million is a guidepost. It's not a hard line. If a company has 100% inflation, you can find much smaller inventories that would provide a worthwhile benefit. And here are a few examples. So 2021 had great inflation in terms of LIFO. Horrible inflation if you're trying to run a business or buy food at the grocery store, but from a LIFO perspective, it has good inflation. So a furniture retailer, which isn't usually thought of as a great candidate for LIFO, had 10% inflation. And with a prior year inventory value of $2 million, they had $200,000 in tax savings this year. For a wiring devices manufacturer, think a lot of metal in wiring devices, they had about 40% inflation. So close to $5 million in additional tax deductions. And you can see the high point is a custom metal fabricator who had 50% inflation, which gave them $10 million in deductions. And let me tell you, In 2021, that is actually low for some metal companies. It's not unusual to see a metal company that had actual inflation of 200% or more. So, high-level lessons on LIFO. LIFO reserve, that is the cumulative difference between the inventory at LIFO and at FIFO, it'll generally increase. That's because, one, inflation is sticking around. For the most part, since the Great Depression back in the 1930s, the US economy has been on an inflationary footing. Now, there's been occasional bouts of deflation in certain sectors or in certain time periods, 1950s, around 2008, but by and large, there has been low, persistent inflation for the last almost 90 years. And LIFO, when you want to think about it, has two components. You have an effect from inflation, and you have an effect from the quantity. And the inflation effect, if you're just thinking about your company and whether it's a good target for LIFO, this is how you do it. You look at your prior year inventory, say it's $5 million, and you look at your current year inflation. Well, where do you get current year inflation? One, you can have an estimate based on your own internal price experience. Ask your cost accounting people how much have our prices gone up this year, and let's say they say 50%. Well, that means prior year inventory $5 million, 50% inflation, $2.5 million potential benefit to LIFO. Of course, in real world, you'd multiply that by your tax rate to come up with how much you'd actually save in income taxes. And now there's also a quantity effect. And when your LIFO inventory, when your inventory is smaller in constant inflation adjusted dollars than it was last year, you have to give back typically a little bit of your LIFO reserve. And the quantity effect is just the amount of the reserve that's paid back due to that quantity decrease. Don't really worry about that too much. Due to how the math works out, the main driver most years is going to be that inflation effect. Unless, of course, you're an automobile dealer in the last couple of years where they've had no inventory. And as Will can tell you, that's a very unusual circumstance. I mean, that's a once in a century type circumstance that we haven't seen as an industry probably since World War II. All right, now I'm going to talk really briefly about LIFO methods. There are tons of them. Now, there are two big ones. The first one is the IPIC or IPIC method. That's the inventory price index computation. That uses indexes from the government, from the Bureau of Labor Statistics, both the consumer price index and the producer price index. Then there are traditional LIFO methods, which I call internal index methods because they're based on a company's internal price experience. And what you don't find is methods based on other indexes, such as precious metal index based on a market. And finally, there are auto dealers. They have special methods because they're a large, unique industry that they have alternative methods for both new and used vehicles, which are just a simplified subset of traditional LIFO methods. Now, the IPIC LIFO method was developed way back in the 1980s by the Internal Revenue Service when Congress said, hey, you got to come in here, come up with something simplified to minimize controversy between the IRS and taxpayers. It was last revised in a big way back in 2002. The BLS publishes indexes each month, and if you're a retailer, you can use the consumer price index. And if you're any type of taxpayer that can use LIFO, you can use the producer price index, even if you're a retailer. And these are all, it's important to note, a domestic measure of inflation. So if everything is coming from offshore, then you may actually have falling prices, but the domestic inflation says you have inflation. And that means you can recognize some sort of LIFO arbitrage in that situation. Now, there are about 2,800 producer price indexes that generally apply to LIFO, 350 consumer price indexes. So if you have a substantial inventory with a lot of stock keeping units, well, you can imagine it takes quite some time to categorize all of that inventory to the most detailed code, which is what the regulations require. Because those codes range from high-level two-digit codes, such as, say, leather and leather products or prepared foods, all the way down to detailed 8-digit codes, such as mechanics hand tools would be a good example. And now there are even some 9 and 10-digit codes. So actually using the IPIC method, it does take some investment to get it up and running. And here's an example. 2-digit code for transportation equipment, all the way down to vehicle seating and interior trim, which is a type of motor vehicle part. And why would anyone use the IPIC method? Well, I mentioned the inflation arbitrage because it's, domestic, and you may have overseas inventory sources. There's also simplicity. And if you're coming from a different LIFO method, there is actually formal audit protection when you change your accounting methods. Now, there's also informal audit protection because it's, let's just say, because the IRS designed it, there's a lot more opportunity for the method to conform to what the IRS actually wants, and very few areas of controversy. Now, traditional LIFO methods, they measure changes based on internal costs, and there are innumerable variations. And the auto dealer versions, the alternative LIFO method and the used vehicle alternative LIFO method, they're simplified variations on traditional LIFO that look primarily to the base cost of a vehicle on a dealer invoice. And typically you'd look at the entire cost of an item of inventory, but not for dealerships. So the reason you'd use this is you might have a better tax benefit than using IPIC, or you might have a better tax benefit sooner because your company actually is experiencing inflation and later deflation perhaps sooner than the official indexes recognize. You might have, say, ton of inflation in December, they don't recognize until March or June of the next year. And the nice thing about traditional LIFO, you can elect it automatically if you aren't using LIFO already. But if the benefit turns south, or if you want a audit protection for your method, you can automatically change to the IPIC method down the road, whether that's 1 year or 10 years. And traditional LIFO methods, they do have one big issue, and that's item definition. And it's kind of easy for some industries. If you're a grocery store, each universal price code or stock keeping unit, you can think of that as the item. But what if you're something like a vineyard, a winery, a petrochemical company? And in those industries, the IRS likes to argue that however you've defined the item, it's too broadly defined. And so there's a lot of controversy in that area, which is one reason why IPIC makes a lot of sense. And then there's another issue. If you don't have identical items in your current year inventory and your prior year inventory, you either have to give up inflation on that, or you have to demonstrate that the reconstructed cost of your current inventory at last year's prices properly reflects income. And that can be tricky. There are a number of ways to do it, and sometimes the service takes exception. Now, what if you want to use LIFO? You have to attach what's called a Form 970 to your tax return. If you're familiar with the Form 3115, the application to change accounting methods, it's like that, but it's only a 2-page form and it's generally speaking automatic approval, just like most 3115s. It's fairly easy. There's also, unfortunately, the conformity requirement. When Congress approved LIFO back in the 30s, they said, well, we'll only let you do this if your accountants approve it, your auditors approve it for book purposes, reporting your earnings. And well, that requirement is still there. So you have to, any statement of earnings to your creditors, to your owners, to vendors, if you're a public company, public financials, all of those have to use a LIFO method. Doesn't have to be used the same method. It could be, a wildly different LIFO method that reports much higher earnings than your tax method, but you have to use some nominal LIFO method. Then finally, and this can be a bad one, if you've taken big lower of cost or market or similar adjustments, when you adopt LIFO, you have to state your inventory at cost, and those have to be restored to income over 3 years. Now, our process generally starts with requesting prior year LIFO work papers, general information, and we provide a no-cost estimate of what it looks like your inflation benefit could be. And there are different levels, like here's a high-level website estimate of a chemical company. We go through the website, we identify the inflation based on government indexes, that IPIC method, of what could be in their inventory. And if that looks like a good estimated inflation, which that's just a simple estimate, it's an average. And so if you're looking at this and it's your company and well, hey, 50% of our inventory is sulfuric acid. That has 56% inflation. Yeah, we're going to look at IPIC. We're going to look at LIFO. And you also can see the estimated after-tax cash savings. Now, beyond that, we can do detailed estimates, both for internal and IPIC methods. And when we do that, we sit down with the company and say, here's what your inflation looks like this year. It's 10%. You have an inventory of 25 million. This is what you're going to get as a benefit. And this is your historic inflation, 6% in your industry over the last 5 years. And then we walk through, what are your expectations for FIFO inventory growth? How do you think the tax rates are going to play out over the next 5 years? What are your inflationary expectations for your inventory over the next few years? And that way we can walk through live all the different possible results that you might see over the next few years. And you get a sense of, bottom line, what's it going to look like? How much cash are you going to save or lose, possibly, depending on the assumptions you use over the next 5 years. And we very rarely, almost never, see an actual loss there. And this is finally an example of one of our actual calculations where we run a number of different scenarios and you're able to choose the most beneficial ones. And with that, I'll turn it over to Will.
Thank you, Brian. Over the next couple minutes, I just want to spend a little bit of time with you to go over some of the practical considerations of LIFO based on my client experiences. And some of these points Brian already mentioned, but I'm going to reiterate them over the next couple minutes or so. So the deferral of tax is the most significant tax advantage and cash flow advantage that LIFO brings. Essentially, you're receiving a tax benefit today that eventually, though, you will have to repay back to the government. And I'll get into that a little bit, because LIFO, unlike other tax credits or benefits such as bonus depreciation, that accelerated tax benefit, the LIFO tax benefit, again, eventually has to be repaid with the establishment of reserve that fluctuates from year to year. So essentially what a company is receiving is an interest-free loan from the government As long as they stay on LIFO and the LIFO reserves are there for them, they're funding part of their operations with the cash flow savings from the tax benefits they received from implementing the LIFO method. The deferral of the tax has to be repaid when, for example, a company goes through an asset sale or an equity sale. In an asset sale, if you sell the asset to your company, your company terminates doing business, whatever the reserve balance that you have on your books at that point in time would have to be picked up as taxable income in that year. If there's sales of equity amongst shareholders or partners in a partnership or members of an LLC, there's typically an economic valuation of the reserves that are sitting on the company's books to determine what the values are, and there is some tax pass through to the exiting partners or shareholders that have to be defined, and the partners would have to pay the tax on those dollars. As Brian mentioned, I am the co-leader for our firm's auto dealership practice, and as many of you know, if you've driven past a car dealer lately over the last year or two, or tried to buy a car over the last few years, there's practically no inventory. And because of that, many auto dealers had to pick up, well, not many, some of them had to pick up to 60 or 70% of their LIFO reserves. Brian and his team have alternative methods to minimize that impact that our clients spoke to source advisors about. But for the most part, reserves decreased dramatically, and there was a recognition of those reserves in the tax. What's interesting, though, is that some car dealers decided to just get out and elect out of LIFO and pick up the rest of their reserve over time, which is allowed under the tax code. But others decided to stay in. And Brian mentioned earlier the leave it for others concept. He's part of the other. Many of our clients look at leave it to others as a generational thing. Their businesses have been passed on to them by their parents, and they're looking to pass them on to their children. They look at LIFO as leave it for others to deal with in the future, and let's reestablish those reserves or maintain those reserves, and any of the tax benefits related to them, just keep passing them on to the next generation. It's interesting, the auto world, Congress is looking possibly to pass some legislation that might give auto dealers relief for the reserves that were picked up in 2021, but that hasn't gotten through to an actual vote on a law that's gotten to the president's desk, which is interesting also because occasionally from time to time, the IRS rears its head and decides, hey, we want to get rid of LIFO, but that's been going on for ages and it has never come to fruition. As Brian mentioned, the books of an entity and the taxes have to be aligned. So if you elect LIFO for inventory purposes, for tax purposes, you must also elect a method of LIFO for your books. And that's important to understand because if you have an international presence and you're reporting outside the US for any reason, you have to check and see if the countries that you're reporting into allow the LIFO method as a method of accounting for inventory. There's also the additional cost of compliance on an annual basis that you have to deal with. And it's something that you just have to monitor. So LIFO is an effective tool to defer taxes, but LIFO needs to be continually managed and analyzed. And that is why our clients partner with Citrin Cooperman and source advisors to help them analyze whether it's beneficial for them to maintain, to keep going, or even to change methodologies as they go through. So I want to pass it back on to Mark and see if there's any Q&A questions that anybody raised.
Well, thank you, Will, Brian, and Jennifer. That was really informative. I do see one question that just came in. All right, will there be a webcast recording? Yes, there will. That'll be released soon. We'll kind of clean it up and send that out. But I think today was really informative. It's definitely a unique environment that we really haven't seen in a long time. So I think there's a really good opportunity here to at least explore it. As Will and Brian alluded to, there's a lot of complexities with it. Will, you mentioned, international. There's also just, your normal banking agreement. I find there's a lot of, you have to kind of walk through with your bank agreement, make sure they're on the same page of what LIFO actually means, because it's going to be a lot different than what their income is on FIFO. So lots of complexities, but it's a really good tax saving strategy. So thank you everyone for your time today, and Brian, Jennifer, and Will, thank you for your help.